What's up, guys? My name is Nick and welcome to the channel. In this video, I'm going to be talking about the top 5 stocks to buy in February. And guys, before I start the video, don't forget to comment down below, like the video, and subscribe. So guys, what we're going to be looking at today is the share price, 52-week range, the volume, the market cap, the beta, the PE, the EPS, the dividend yield, and profitability, like the balance sheet and the income statement. And so my first stock today is UNP, Union Pacific Corporation. And guys, the reason I chose these stocks that I chose today is because I believe that they will all be recession proof. And I believe that they all have their own little thing that makes them irreplaceable and valuable. So Union Pacific Corporation, publicly traded railroad holding company, started in 1969 in Utah, and they're prepared to ship just about anything from food, forest products, automobiles, coal, chemicals. Even if you don't want to ship something by rail, their shipping capabilities aren't limited to that. They can coordinate, it says, through their shipment, through our network, through other railroads and other services on the road. And something I wanted to point out down here is that transportation, 28% of the transportation is done by railroads. And the great thing about Union Pacific Corporation is not only do they not have their own infrastructure, they are infrastructure. And it's very difficult barrier to entry to start your own railroad corporation. So now let's look at Seeking Alpha. As you can see, their price is $246.49. Their 52-week range is 195.68 to 256.11. Their earnings per share is 11.54, which is pretty good. Their PE is a solid 21.05. Then if we go down to their market cap, is 153.59 billion, and then their volume is 3.1 million. Now if we go to dividends, scroll down, you'll see that they have a 1.77% yield, a solid 43.07% payout ratio, and an awesome 5-year growth rate of 13.73%. And they've been growing their dividend for 14 years, which is definitely what we like to see when we're looking at dividend companies. Now, if I go over to their financials, as you can see, their revenue looks like it's going a little bit up and down, and they got hit by the pandemic. But in 2021, you can see that their revenue is growing. So they're doing positive on revenue. And I did want to go into the peers tab and scroll down here to see revenue growth. It grew 11.63%. If we look at their profitability, 58.46% gross profit margin, which is good. 9% return on assets, which is also something that we like to see. And they have a beta of 1.05, so that's pretty good. That means they're slightly volatile. And then as you can see, they had the highest revenue at 21.8 billion and a net income of 6.52 billion. And they have total cash 1 billion, total debt 31.49 billion. However, they're earning a cash flow of 9 billion. And so that is Union Pacific Corporation. Now let's go back to the slideshow and to our second stock, which is Fastenal. Ticker symbol FAST, FAST. So Fastenal is many things to many different customers: consultant, logistics, technology provider, and a distributor of wide-ranging industrial and construction products. So they have service model centers in about 3,200 market locations. They provide customer inventory and a dedicated sales team to support their local customers. And guys, one thing I want to say about Fastenal is they've got contracts with large fulfillment centers and companies like Amazon. I work at Amazon and I use Fastenal every single day at work. We have vending machines. They have all kinds of products from gloves to vests to even painkillers. And they just have a large, wide range of products. So when I'm looking at a stock, I'm thinking, well, if I use it at my workplace, Amazon, there are hundreds of Amazon warehouses. I can imagine that you can probably find Fastenal in like Walmart warehouses, maybe Kroger, Costco, and just like think of all the many warehouses and distribution centers there are. And a lot of times they're probably using Fastenal. So we have a stock price of 54.51, 52-week range of 43.37 and 64.75, EPS of 1.79, and a high PE ratio of almost 30. Then they have a market cap of 30.76 billion and volume of 3.1 million. Now, if we go to the dividends, you can see they have a 2.31% yield, a high payout ratio of almost 70%. But they're another great company with a high dividend growth rate of 13.52%. And they are 1 year off of being a dividend aristocrat. Now, I'm actually just going to go straight. Now, let's go to the financials and see their revenue. So as you guys can see, their revenue has been increasing year to year, which is good. And something that I read in my research was that Fastenal is increasing their e-commerce sales. And if we scroll down, just want to look at revenue growth of 6%, 6.44, a little lagging behind their competitors. But we do have a solid gross profit margin of 46.2%, which is higher than their competitors, so that makes up for it. A return on assets of 18.41%, and revenue of 6 billion, net income of 925 million, total cash 236 million, total debt 636 million. So not too bad right there. And cash flow of 770 million. So now guys, let's go back to the slideshow and get to our third stock, which is ABM Industrials Incorporated. And basically what they do is they take care of clients from aviation, banking, life sciences, commercial office buildings, real estate, education, food and beverage, healthcare. So you can see there's so many of these, warehousing, and they say they provide a wide variety of services from airport shuttle service, wheelchair assistance, food and nutrition, to mission critical hospitals. And another thing I want to say about ABM, they have a contract with Amazon. And so without ABM, like Amazon could not run because they get rid of all the trash and all the cardboard, and they do all the cleaning. And if you actually go on Indeed, you can see tons of jobs for ABM for all different types of warehouses, distribution centers. So this is another stock like Fastenal that I think would perform well in any market cycle, especially if there's a recession, because Amazon is not going anywhere, and neither is Walmart if ABM has a contract with them. So we have a share price of 41.78, 52-week range of 38.44 to 55.48, EPS of 3.42. They actually have a fairly low PE ratio of 12.15, market cap of 2.71 billion, and 306,000 volume. So now if we go to the dividends, they have a 1.88% yield, a very low payout ratio of 21.23%, and they do have a low dividend growth CAGR of 2.84%, and they have been growing their dividend for 8 years. Now, if we look at their financials, you can see that their revenue was increasing, and then after the pandemic, it fell a little bit, but they're coming back because their total trailing revenue is increasing, which is good to see. Now, if we go into peers, you can scroll down and see that they had revenue growth of 4% after the pandemic. They have a 16% profit margin, 5% return on assets, and oh yeah, it looks like the beta. So they do actually have a little volatile at 1.44 for their beta. They had 6.23 billion in revenue, net income of 126 million, and total cash 62 million. Total debt, so that's quite high, 1 billion. However, their cash flow is a third of that at 314 million. So let's move on to the next stock, which is going to be Next Era Energy, ticker symbol NEE, N-E-E. So they're an American energy company, and it says right there, revenue of 18 billion in 2020, and is the largest electrical utility holding company by market capitalization. And as you guys can see in this map, this is where they service. So they're in quite a lot of states and cities throughout the United States. And if we go over to them on Seeking Alpha, you can see their share price is currently 76.66, 52-week range of 68.33 to 93.73, EPS of 2.79, a PE of 27.06, market cap of 148 billion, and a volume of 7.39 million. Now, if we go to the dividends, they have a yield of 2.04%, a 60% payout ratio, and another phenomenal 5-year growth rate of 12.1%. And they're a dividend aristocrat with 26 years of growing their dividend. And that is their 60% payout ratio is sustainable. Now, if we look at their financials, their revenue did take a dip in 2021, that may be from the pandemic, but I believe that they will come back, especially their revenue is probably declining because they are investing in more green energy. And if we go to the peers and scroll down, you can see, yep, their revenue growth did decline by 5%. So we're hoping for them to increase that. However, they do have a solid profit margin of 50%. And if we scroll down, see they have a 0.99 beta, which is good. They have 17 billion in revenue, a net income of 3.57 billion, total cash 639 million, total debt, which is really high, 54.83 billion. However, they do have cash flow of 7.55 billion. And now we're going to go into our last stock, which is Starbucks. So we all know what Starbucks is. They sell coffee. However, something I wanted to point out, China is their fastest growing market, and it's the largest out of America. And they said their CEO said that their sales growth was 91% in China. And every time Starbucks puts up a location in China, it performs really well. and it's just bringing in a lot of revenue. And that is their goal going forward, is to keep opening locations in China. It's kind of similar to Costco. Whenever Costco opens up in China, they just get swamped with business. So Starbucks has a price of 97.13, 52-week range of 93.79 to 126.32, 3.34 EPS, kind of high PE at 28.44, market cap of 109.5 billion, and a volume of 9.349 million. If we go to their dividend, they have a 2.06% yield, a healthy payout ratio of 56.12%, and an insane 5-year growth rate of 16.7%. And they've been increasing their dividend by 11 years. Now, if we go to their financials, as we can see, their revenue has been increasing over the years, but it did take a hit during the pandemic. However, they came back in 2021, and the revenue just keeps increasing, and they're doing great. Now, if we go to peers, we can see that their revenue growth increased by 31%, which is amazing. Their profit margin is a little bit lower at 28.7%. Their return on assets, 10.48%. They have a beta of 1.13. They have revenue of 30.36 billion, which is beating their competitors. Net income of 4.39 billion. Total cash, 4 billion. Total debt, 23.75 billion. So it's not that bad, net debt. And net operating cash flow of 6 billion, which is solid. And so guys, that is the end of the video for today. Thank you for watching. Don't forget to like this video, comment down below because I'll be answering all your comments, and subscribe.